Hopefully everyone can confirm my audio is coming through loud and clear. If there are any issues with my sound, please message me in the chat, and I will do what I can to correct it. So I'm looking forward to today's session. Today we're going to be talking to you about deductible or business expenses and what you can deduct. Specifically, I'm going to start with a little bit of housekeeping, a little bit about our firm and how we add value. Then I'm going to talk a little bit about what our process looks like. Then I'll talk about our standard chart of accounts. And then finally into what you guys are here, the various things that you can expense. And we're going to break that into expense accounts as well as asset accounts, and try and break down the difference between the two. And lastly, I will close with some additional resources where you can find more information if you need it. So if you do have any questions, I would encourage you to post those in the Q&A. I will be answering questions in this order: Q&A first, then I will look to the chat, and then lastly, if anyone raises their hand, I will activate your mic so that you can speak. For those of you who are watching live on Facebook, as opposed to in the Zoom meeting with us today, you can post your questions into the comments on the Facebook post, and one of my colleagues will then bring those into the chat in our Zoom meeting. So without further ado, let's kick off. And that's, of course, my mouse is giving me problems today. It died and doesn't want to come back to life. But a little bit about who we are and how we add value. So many of you are clients, but some of you are new to our organization. CPA 4IT is an accounting firm specializing in small businesses and independent contractors. We've been doing this since 1984 when my father, George Wall, founded the firm. We have a couple of things that we do very uniquely. One of them is going to be our standard chart of accounts, which we'll be talking about today, but we also offer audit representation protection. So in the event that you are audited and you're a client of ours who is on one of our packages, we'll represent you up until the third and final stages of appeals at no additional cost to you. We also do a financial benchmarking against industry averages to show you how you compare to the average and the median. We could not do that without our chart of accounts, which we're going to be talking about today. We also do proactive strategic planning with you and financial quarterbacking to help you not only organize your finances, but to create wealth and transform that wealth into a legacy. And when it comes to creating that legacy, one of the best tools that our clients have access to is our business coaching and management training that is done by my father, who is quasi-retired, but he's helped thousands of small businesses owners, actually tens of thousands of small business owners over his career, as well as done a whole myriad of businesses from real estate development and real estate management to bars and restaurants, to travel agencies, to owning schools. If there's a business, he knows about it. So that's a great resource for you. And if you're interested in learning more about that, feel free to reach out to my dad if you're already connected with him as a client of ours, or check out our Value Builder program on our website. In addition, we offer a number of seminars and streaming videos like today's session. The goal of these is to help our clients better organize their finances, create wealth, and transform that wealth into a legacy. And lastly, we do financial planning with our clients. So we look at where you are now, where you want to go, and how you're going to get that. My dad often referred to this as the pyramid of power: the now, where, and the how. But that's our little, that's all. I'll leave it for our sales pitch on who we are. But I do want to talk to you, for those of you who are new to our organization, and just walk you through our process so you can understand timelines and what that process looks like. So when you send us in your information at year end, we will do an initial preview of that file, make sure that we've got all the information necessary to proceed. Assuming that we have all the information and we don't need to go back to you for additional information, we will begin the data entry on that process. Now, this is really important step is when you bring in your year-end information, we do have a corporate year-end checklist. Please, 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 please make sure that you are providing us with all the information that is in that checklist. Anytime that we have to stop work, go back, collect additional information, the amount of time and energy that's going to go into completing that file, both in billable time as well as in elapsed time, is going to go up quite significantly. As you can imagine, if you guys are working on anything and you get interrupted, they say that any interruption could easily add 25 minutes of additional billable time into a working file. So every time that we got to go back to you with missing information, we are increasing that billable time plus the elapsed time, because now we got to wait for you to get back to us. And then if the team member who is asking for information gets onto another project, they may have to finish that before they come back to your project. But once the data entry is complete, we go through our first review. This is done by an account manager or CPA who's going to look at your file, the data entry, make sure that it meets all of our requirements. Once we're happy with that, we will book a review meeting with you. This is where we're going to look at your year end. We're going to run through our benchmarking analysis. We're going to see what we can do to maximize those expenses and minimize that tax, as well as look at the tax planning as far as how we're going to distribute any of the money that's come out of the corporation, and look at that financial plan of where you are now, where you want to go, and how you're going to get there. After that review meeting, we do a final post-review data entry. So any changes that might have made or come out of that review meeting will be adjusted. Then there's a final QA test that's done by our office manager, Oksana Sikacheva, who has been with us for more than 2 decades, who has reviewed tens of thousands, maybe even hundreds of thousands of files. And again, that's a quality control check just to make sure that we've dotted our I's and crossed our T's. Once that's done, we'll release the final package and we'll ask you to sign off on the return, and we will e-file your package. That entire process normally takes about 6 to 8 weeks. So I just want to set expectations. Sometimes we can do a little bit faster. Sometimes it takes a little bit longer. That is our average. We are working to do everything we can to shorten that cycle, because we know that the things you value most are speed and accuracy and, of course, cost. So we are constantly working to leverage the latest in technology to make this process even better with you. We've released a new tool called Lisio to help improve that. We're always looking at the latest and greatest technology to try and make this process as good as we possibly can. But at the end of the day, we're here to talk to you about what you can deduct, what you can expense, and how you should organize that information when it comes to organizing your finances. So first of all, I want to explain to you what a standard chart of accounts is. It's lingo that we as accountants use all the time, but sometimes I know these TLAs or 3-letter acronyms that I throw around so readily, you may not be as familiar with. So I do want to take a minute to explain what a chart of accounts is, and why we use the standard chart of accounts, and why you shouldn't go off and just build your own chart of accounts willy-nilly. So first of all, a chart of accounts is a financial organization tool that provides a complete listing of every account in the general ledger of a company. And it's broken down into subcategories, including separating that into expenses, revenue, assets, and liabilities. And this helps us to ensure that the financial statements are, of course, in compliance with reporting standards, which is essential. So what happens is that standard chart of accounts gets mapped to something called a GIFI code, which is what CRA uses to acknowledge and process your actual corporate tax return. So this is the key thing that is going to link the financial statements to the tax return. So it is very, very important. You can have all sorts of different chart of accounts. There's lots of people who use completely different chart of accounts. There's often chart of accounts that will be specific to various industries. We have a standard chart of accounts that's meant specifically for service businesses. We do have clients who are primarily IT consultants, doctors, and realtors, who are all going to have the same standard chart of accounts. We do have some clients who are in the e-commerce business. You're going to have a slightly different chart of accounts, and we will customize that for you. But the reason that we use a standard chart of accounts across all of our IT consultants and across all of our doctors and across all of our realtors is because the standard chart of account allows us to run a benchmarking analysis. If we weren't using a standard chart of accounts, we wouldn't be able to create that benchmark analysis and show you how you compare to the average and the median. It also allows us to leverage things like bank rules in QuickBooks Online. So QuickBooks Online, which you guys know we do a lot of seminars about that. I'm a huge advocate of cloud accounting, a huge advocate for QuickBooks Online. And one of the great features of QuickBooks Online is that we have the ability to have the bank feed, which eliminates the typing and keying of transactions, but we also have bank rules. And bank rules are the things that allow us to create these rules for the bank transactions that tell us how those transactions are coded without us having to go in and code each and every transaction. Now, these bank rules that we create will only work if we have a standard chart of accounts. Well, I would say this, they won't only work. We can only copy those from one account to another if we use a standard chart of accounts. At the moment, we do not have these bank rules available for purchase or download, but I can tell you that this is a project that we're working on right now, is to be able to make those bank rules available for you to be able to download and import into your QBO account. So all the bank rules that we have created for the bookkeeping that we do for all the clients that we provide bookkeeping services for will be available to our CPA for IT clients to be able to download and import into their QBO, which will save you huge amounts of time. So it's coming. I'm just planting the seed right now to let you know that there's some amazing tools, and they only work because of this standard chart of accounts. Now, you can find out more information as well as download the standard chart of accounts. Right now, that's available in ShareFile. I know we mentioned Lisio, and we will be replacing ShareFile with Lisio. For right now, we are still continuing to use ShareFile, where you can go in and you can download from our free resources section our CRED manual, which stands for Capturing Revenue and Expense Data, which is going to have the standard chart of accounts built into it. You can download the chart of accounts just in a CSV that can be used to be imported into QBO or imported into any other general ledger software, as well as you can get a breakdown of what we're going to go over today, which is the various expense accounts and assets accounts, with a more thorough description of everything that we're going to cover today. Because today's session, I really want to keep it brief, give you an introduction, answer questions. But I know one of the things that we've been getting as far as feedback is we don't want these sessions to be an hour long and steal your entire lunch. We want to keep them a little bit shorter and make sure that you guys have time to get back and get some food while getting tremendous value out of these sessions. Okay, here we go. So first of all, let's talk a little bit about what is deductible and what the rules are from CRA as far as what you can and cannot deduct. So first of all, if an item is specifically disallowed by the Income Tax Act, you can't deduct it. There's no, that's not gray, it is black and white. If it's specifically disallowed in the Income Tax Act, you cannot deduct it. The good news is there are not many things that are specifically disallowed by the Income Tax Act. Some of the most notable things that are specifically disallowed by the Income Tax Act are golf green fees, club memberships, your primary telephone line. Now, if you have a cell phone, secondary lines, business lines, calling features, long distance, all of that can be deducted, but the primary home telephone line is specifically not deductible. And when it comes to golf green fees, while you can't deduct the green fees, you can deduct the 19th hole. So if you are going out with the guys and gals for a round of golf, and those people are employees of your clients or people you network with, allow them to pick up the golf green fees and you can pick up the 19th hole, which will be deductible. The other things that are not deductible are club memberships. So unfortunately, gym memberships, those types of things, golf clubs, private country clubs, anything like that is again going to be specifically disallowed. And then the other thing that's going to be specifically disallowed is life insurance. Now, life insurance is this really complicated thing, and we'll talk a little bit more about it when we get to the insurance section. But if you are mandated by your bank that you are required to have life insurance, then it can become deductible. Otherwise, it becomes what we call an add back. So an add back means you are not actually able to deduct it for tax purposes, but you're allowed to include it on your income statement. What that does is it means that the money that you spend on that insurance, if it's under the corporate name, doesn't become a director's advance and therefore salary, which then means, well, it's not deductible. You are paying for it with money that the corporation has paid tax on at the corporate tax rate of only 12.5%, versus money that you personally paid tax on, which could be taxed at your marginal tax rate, which could be as high as 53.53%. So outside of those things that are specifically disallowed, what can you deduct? Well, the rules basically say that it's anything that is first of all reasonable and has the intent to help your business earn income sometime in the future. So first of all, reasonable, that's subjective. Has the ability to help your business earn income sometime in the future. That's kind of vague. So this offers a lot of room for interpretation. And what we believe is that our job is to help you understand how you can interpret these rules as reasonably as we possibly can to maximize those deductions. We're one of the accounting firms that doesn't believe our job is to tell you what you cannot deduct. Our job is to help you understand what you can deduct and help you to maximize those deductions. Because every dollar that you are able to deduct is a dollar that you will not pay any tax on. So you won't pay personal tax, you won't pay corporate tax. This is one of the greatest advantages of being a small business here in Canada. The government recognizes that you spending money is going to help build the economy, and it is an important part of what you do for your business, and therefore you do not need to pay tax on these. And so how that works is because basically you have revenue, and you subtract your expenses, and you pay tax, corporate tax, only on what's left over. So let's walk through some of the things that you can deduct. So I'm going to start, apparently with a blank page, with our expense accounts. So first and foremost, you can deduct our fees. That's really important. So if you're ever looking to add more expenses into your business because you're about to hit the max small business deduction, I'm always happy to increase our fees because those are 100% deductible, though I'm sure you don't want us to. So under accounting fees, you would of course have our services. If you had a bookkeeper, if you were using any other services to prepare your financial statements for your accounting, for your small business, those are 100% deductible. That's pretty straightforward, so I'm not going to spend much more time on that. The next thing that you've got is advertising expenses. So some of the things that are obvious here are traditional advertising. Right now, those are things like Facebook ads, YouTube ads, Twitter ads, traditional magazines. Now, one of the caveats here is if you are using print, it's got to be a Canadian publication in order to be deductible, which is really interesting because you don't have that requirement when it comes to digital, but that is a requirement when it comes to print. But in addition to traditional advertising, the other thing that you're going to have here are things like gifts. So if you're providing gifts to your clients or prospects or even colleagues that help you to network and build relationships, those would fall under advertising expenses. In addition, one other thing that is very unique about advertising expenses is if you are holding an event, you can deduct that under advertising. So an event might be like, let's say, a New Year's party or an end of tax year celebration like we often do. That can be deductible under advertising under instead of meals and entertainment or business promotion. That is a really, really important distinction because advertising is going to be 100% deductible. Meals or entertainment / business promotion is only going to be 50% deductible. And we'll talk a little bit more about why that's 50% deductible and how that works and how you track that. But understand that if you're having an event, and the criteria for an event is you have to invite all of your employees, which for many of you, you are probably the only employee, but all your employees have to be invited. And of course, you are not doing events on a daily or even weekly basis. So you have to be reasonable there. And we have a guideline around here. And of course, it just slipped my mind as to, it was a great quote. Here it is. And this was taught to me by Bob Novoselic. For those of you who've been around, you know Bob worked with us for decades. And his expression that I love is pigs get fat, but hogs get slaughtered. So when it comes to any of this, what I encourage you to do is track absolutely every dollar that you spend. Categorize it to the best of your ability into the expense category that we're going to discuss today. And let us run our benchmark analysis and show you how you compare to the average and the median. And that's a great way for us to identify whether you're a pig or a hog. And that, of course, gives us the opportunity to adjust it in our year-end review meeting. Because it's always better for me to have a set of books in which I am making reductions or removing out expense categories rather than coming to the end of the year, asking you some questions and being like, oh, hey, did you do an event? Yes, you had an event. Let me make an entry and do an adjusting journal entry on that now, which I absolutely can do. But if you can imagine, if you go through an audit and an auditor comes in to look at your financial statements and he sees all these journal entries to add in these things with no supporting documentation, those are the first things he's going to ask you about. Whereas if you have a bunch of journal entries and transactions for these whole list of things, and then you have a transaction and remove out the personal portion of those items. That looks a lot more reasonable to the auditor, even if the end number ends up being the exact same. It's just about presentation and the appearance of what that's going to look like to an auditor. So it's really important for you to track every single dollar that you expense. So I want every one of you to go out and get a corporate credit card. We just did a blog post about benefit programs that you can get these amazing Amex cards for your business under business credit cards that every one of you can get. And whether it's the platinum card, which is going to give you the greatest bonuses and incentives, or the gold card, or even just their cash card, you can go out and get a card, use that exclusively for your business expenses. And if you don't want to use Amex and you can only get a personal card, I don't recommend that, but that's still better than mixing and matching everything. But put everything on these debit cards and credit cards, link those into something like Kubio, have the bank feeds suck those in, use bank rules to categorize them, and we're going to make your accounting and bookkeeping just a breeze. But without further ado, I want to continue on to automobile expense, which is the next category. Now, automobile expense is the first category that we're going to call a percentage of use category. So by percentage of use, what I mean by that is we are only able to deduct a percentage of this based on your business use of that vehicle. So one of the things that we need to track in order to calculate your percentage of use is the mileage on your vehicle and how much of that mileage you drove for business purposes and for personal use. So when we track mileage, we now have a couple of options. There is a mileage rate prescribed by CRA that allows us to do a calculation where you don't have to keep track of your fuel and your insurance and your depreciation and or your lease payments or all the maintenance that goes into your vehicle. You just simply track the mileage and we keep track of the mileage. In many situations, if you have an older car, the mileage method will usually work out to be the best way of deducting this expense. However, if you have an older car where, or a newer car where the actual depreciation levels might be higher, we might be better off using the actual expenses. And with the actual expenses, what we will do is we will take that percentage of use and we will multiply that percentage by all these categories that I talked about. So you're going to have insurance, you're going to have either depreciation or amortization. So if you purchase the vehicle, it's depreciation. And if you lease the vehicle, it's amortization. Now, we have a whole blog post on whether you should buy or lease. I'm not going to go into that now because I could spend a whole half hour on that. So if you want to know whether you should buy or lease, go to our website, do a search buy versus lease, go to our YouTube channel. We've got lots of great videos explaining whether the advantages of buy versus lease. But in either situation, there is going to be a cap. So when it comes to depreciation, there's some new rules when it comes to electric vehicles, but outside of that, most of you are going to fall under the standard class, which has a maximum depreciation of $30,000 plus HST. Now, when it comes to leasing, there is a maximum on that. It's basically $800 plus HST. It gets a little bit more complicated because you're supposed to factor in what the purchase price is, and there's a more complicated calculation that goes into that. I can tell you when CRA agent comes in, if they see that you capped it at 800, they're generally happy with that. What we tell all of our clients is to track both, because if you track both, we can make the decision at end of year as to which method gives you the best deduction and saves you the most amount of money. If you don't track both, we don't know which is better, and we use whatever method that you provide to us. So I strongly, strongly, strongly encourage you to track both the mileage and the actual expenses. And you can switch back and forth from one category to the other as well. So next is bank charges. So this is pretty self-explanatory. Bank charges for your corporate credit card. Unfortunately, we can't take bank charges on personal bank accounts. We can't take bank charges on personal credit cards. So if you've gone and you made that choice to use a personal credit card instead of a corporate credit card, we can't deduct those charges for the credit card. And so some of these premium cards that give you all the bells and whistles, like $200 travel credits and free buddy passes and 1 million points when you join, they do typically have an annual fee. Like I think Amex is like $4.99. If you are using a corporate card, we can deduct that. If you are using a personal card, you cannot deduct that. The other thing that often comes in here is as you evolve and start to build up assets inside your corporation and begin to invest those, we're going to have charges for trading and those types of things that will fall under bank charges as well. Books and periodicals expense. Now, more and more people are just getting free information online, which is amazing. But if you do have any newspapers, books, magazines, any of that, that's going to be deductible. Our personal opinion is that everything that you read is part of your body of knowledge and is part of the tools that you bring to the job. And therefore, even if it is science fiction, if it is not related to your industry, that's still part of your body of knowledge. That's important for networking, for relationship building, for water cooler talk. And therefore, everything that you read, in our opinion, is deductible, though more and more we are seeing that this category is decreasing every year. Next is business promotion, account 750, often sometimes referred to as meals and entertainment. So meals and entertainment / business promotion is meant to track those meals and entertainment that you are having on an everyday basis. Now, the requirement for deducting meals and entertainment is not that you ate a meal, it is that you are promoting your business. So that means you need to have a meal with another individual. And I want you to lose the word friends from your dictionary and recognize that everyone that you hang out with has the potential to help your business grow. And you're going to talk to them about how you can network, how you can grow, how you can find clients, how you can build wealth in your organization. By doing that, that's going to make the meals and entertainment that you spend with those people legitimately deductible for your business. In order to deduct it, you are supposed to keep track of who you had the meal with and what you deducted. A lot of people don't do that. You're technically supposed to write that on the back of the receipt. However, if you do have a calendar and you can go back and be able to tell CRA if you go through an audit who you had that meal with and what it was, then they will allow that deductible expense. Keep in mind, business promotion is a 50% percentage of use calculation. So this is another percentage of use account. That percentage is calculated by CRA. It's not up for debate. It's not how much of the meal you ate versus how much of the meal that the person you were with ate, or whether you were with 2 people or 3 people. It's not about that. CRA basically acknowledges that you're getting some personal benefit, so they do an add back on the personal tax return. The good news is that 100% of the money that you spend on this is not going to be personally taxable. However, 50% of it will be taxable at your corporate tax rate. And you don't need to worry about tracking the 50%. You just report it at 100%. We will worry about all of that because that's an add back on the tax return. So just report it at 100%. Keep track of all the meals and entertainment. Do your best to keep a record of who you had that meal with. And do your best to make sure that when you were talking or when you're going out for a meal, you were bringing someone with you. The one exception when it comes to meals and entertainment for not needing to have someone with you is when you're doing meals while traveling. And traveling 2 kilometers does not count as meals while traveling. We're talking about hopping on a flight, going on a significant drive, and then that can be considered meals while traveling. Now, of course, keep in mind that this doesn't mean when you're on vacation, that counts as meals while traveling, unless that vacation is a business trip. And we're going to talk a little bit about that when we get to travel. Computer lease expenses, pretty straightforward. Once upon a time, computer leases were a big thing because computers were really, really expensive. Now you can pick up a laptop for a couple $100. They're almost disposable these days. And that's going to fall more under the assets. And we'll talk a little bit more about that when we get there. But if for any of you who are still doing a computer lease through Dell or something like that, that would be deductible under account 755. Now we're going to continue on with computer supplies expense. Again, fairly similar to computer lease. Now this is going to be supplies, printer, toner, keyboards, mouse, anything under about $200. We use $200 as a general guideline for what we consider materiality for depreciation. I apologize. Let me stop that. Sorry about that. For materiality when it comes to what you should depreciate and expense as an asset. If it's under that and it's doesn't have a longer useful life, you would expense it under computer supply. So again, hopefully that's pretty straightforward. Consulting fees expense. This is a category we used to use quite extensively quite a while ago, before CRA sort of changed the rules and before we had issues around HST. I apologize. So we used to use it for income splitting. We do not recommend doing income splitting through the use of consulting fees anymore. We recommend income splitting either through salary, which is usually the preferred method, or dividends if you have that option available to you. There are new TOSI, tax on split income rules, that will limit that for a lot of you. But again, that's a topic for another day. Where this may come into place is we have a number of firms who are like almost mini staffing agencies who are doing a lot of subcontracting, and you might have your fees either under consulting fees or subcontracting, which we'll talk about in a minute, or when you hire a consultant through Fiverr or Upwork or one of those tools, you might have some individual small consulting fees, and those would fall under this category. Oh, I jumped 2 categories. Amortization expense. Now, this is a category, it's quite important, and it ties into your assets. So this is the portion of the assets that we're able to expense in the current year. So there's something called depreciation. So when you purchase an asset, the government basically says this has a useful life beyond the current year. So you can't expense the entire amount now. You can expense a portion of that. The amounts that you can expense are specific to the asset class. You don't need to worry about all that. We will track all that. You just really need to figure out whether it's a computer supply or it's an asset. And what we say is the general guideline: does it have a useful life beyond the current year? And is it more than $200? In that case, it's going to be an asset. We'll talk more about that shortly. Director's fees expense. So this is going to be typically the salaries for the directors, for yourself. Again, this is typically not something that you're going to put into your bookkeeping as you prepare that. This is going to be done as a journal entry by your accounting team when they do your tax planning. What we encourage you to do when you're tracking your expenses, or sorry, your withdrawals out of the corporation, the money you take out of your corporation, if you're not on a monthly payroll program, like many of our clients are not, many of our clients are typically taking out money as they need it to pay for expenses on behalf of the corporation. And then at the end of the year, we'll do tax planning to figure out how much of the money they took out will become the director's fees. So when you're tracking everything in your bookkeeping and your accounting, the money you withdraw doesn't go to the director's fees expense account 790. It's going to go to the director's advances account under account 150, which is actually a balance sheet account. The reason that's important is because we don't want that to show up under the expense deductions until we've done tax planning. And that tax planning, again, topic for another day. We've got great sessions on that as well. Next is going to be education and seminars. One of the most important things when you are an independent contractor is to constantly be working on and developing your skills. If you're not developing your skills, it's very quick to be left behind by someone who is younger and more on top of the latest and greatest technology. So it's really important to constantly be improving your skills by doing education, doing seminars, going to conferences, those types of things, and doing effectively professional development. Now, if you are getting a government slip, like if you were going through a registered university, if you're going back to do an MBA or something like that, where you're going to get a slip from the government with your tuition fees, you're probably going to claim that under your personal side. Now, if you're going to do a certification or additional courses where you're not going to get that slip from the government where you can deduct it on your personal tax return, you're going to want to put that here, as well as things like I said, conferences and stuff like that. So that would be like the actual conference registration. The hotel and the booking for those conferences will go under travel, which we'll get to in a second. Employee benefits. Now, this is most typically the CPP, the employer portion of the CPP, but it could be benefits programs that you do offer if you have employee benefits programs, which is rare for most of our clients. So for most of our clients, when you see employee benefits, it's just the employer portion of the CPP. And again, this is something that we will track for you. General expense. This is usually a pretty small category, and it's meant to be a catch-all when you don't know how to categorize something, and something that when we see a general expense category that's more than a couple $100, we're going to review that with you to see why you're categorizing it under general expense. So we want to have a catch-all when you don't know where to put things. Insurance expense. Now, this is not your car insurance or your home insurance. Those are going to fall under home office or rent expense and automobile expense. This is meant for things like errors and omissions, life, or disability. So first of all, let's talk about the difference between errors and omissions, life, and disability. Errors and omissions, 100% deductible, and we strongly encourage it. One of the things is being an independent contractor is there's the risk that you could be deemed to be an employee rather than an independent contractor. And again, this isn't a session on personal service business risk, but one of the greatest things that you can do to ensure you're never deemed to be an employee is demonstrate that there's risk for profit or loss. And having insurance, by definition, shows that there's risk for profit or loss, because the reason you buy errors and omission is to protect against a risk, right? So we strongly encourage errors and omissions. Errors and omissions is 100% deductible. There's a great company out there called LMS ProLink that offers some really amazing packages that if you're working through a staffing agency is going to give you probably the best pricing that you can get in the market. And so you have to be going through one of the staffing agencies that's on their preferred list. It's one of the ways that they're able to offer this group benefits package or group program for errors and omission. In addition, we talked about disability. Now, disability, you can deduct if you choose to, but if you choose to deduct it, the benefit that you receive from disability becomes taxable. And for that reason, we typically don't recommend that if you are getting disability insurance, we probably recommend that you don't deduct it. Because if it becomes taxable, if you have to claim a benefit, we want that benefit to come through to you tax-free. Because otherwise, you can imagine if it's going to be taxed, then you're going to need a much larger benefits program, which is going to cost you a lot more money. So we've run the numbers and we typically say it's better off to just not claim it. And then you can have a lower premium that gets you what you need. It gets you the coverage, you can have a lower coverage. Last but not least is life insurance. As I said before, life insurance is specifically disallowed by the Income Tax Act unless it's prescribed by your bank for financing, which is very rare for most of our clients. And just to be honest, if the bank is doing that, they're going to also require either review engagements or audited financial statements, which we do not do. So you're probably not a client of ours if the bank has mandated that. Now, if the bank hasn't mandated it, you can still put it in as an expense inside the corporation, but it gets added back. Just like 50% of the business promotion expense gets added back, the life insurance will be added back. What this does is basically allows you to pay for it, as I said earlier, with money that's been taxed at corporate tax rates instead of money that's been taxed at personal tax rate, which can be a significant benefit when you're talking about 12.5% versus potentially 53.5%. So if you are getting life insurance, that can be a win. But in order to do that, the corporation has to become the beneficiary. Now that's okay because the corporation can flow out insurance benefits through a capital dividend account tax-free to its shareholders, which is again a conversation for another day. But if you are going to get life insurance and you want to be able to claim it, the corporation does need to be the beneficiary. Interest and penalties. Hopefully you don't have anything under this category, but if you do, anything that you would have under interest and penalties would fall under account 840. Next, we're going to have office supplies expense. So this is going to be things, again, it's different from computer supplies. It could be things like light bulbs and garbage bags and stationery and those types of things, as opposed to keyboard and mice and the electronic peripherals. The biggest thing I see people here is they don't keep track of these things because they'll go and do a grocery run and they won't separate out the cleaning supplies and the garbage bags and those types of things, which may not seem like much, but over the course of the year, you'd be surprised at what they add up to, with the typical person having usually around $800 worth of office supplies. Next is going to be the rent expense category. This is typically for most of our clients, it's going to be a home office. Of course, if you do have an actual office that you rent or a WeWork or a Regis or anything like that, that would fall under this category. We do have a specific Excel spreadsheet that we ask our clients to complete when it comes to rent expense, because rent expense is going to be another percentage of use calculation. So if you are using your home office for work, which pretty much all of us are these days, thanks to COVID, we are not going to claim 100% of your home, obviously. We're going to claim a percentage of the expenses of that home as they relate to the percentage of your office space over your total square footage. average person is probably claiming between 20 to 25% of their total expenses in their home. And these are going to be things like your mortgage interest. So not your mortgage principal. This is a really, really important thing. So your mortgage interest, not your mortgage principal, your property taxes, your utilities, your insurance, any repairs and maintenance. Now, these are not capital improvements, but repairs and maintenance. And repairs and maintenance can be large expenses like a roof. It's still considered to be a repair and maintenance. Windows might be a repair and maintenance. If you are changing the value of the home, that's usually considered a capital improvement. And where this can get a little bit confusing is people think, well, I put in new hardwood, that's changed the value of my home. It may have. If you had carpet there before, you've changed the value. If you had hardwood there and it was just old and cruddy and you're bringing it up to its original condition by replacing it with new hardwood, that can still be considered a repair and maintenance. So if you're going to be doing a big repair, come talk to your account manager beforehand to just make sure that we can maximize those deductions. But we're going to track all of those things, all of those landscaping costs, all of that, put them into a spreadsheet, and then take a percentage of all those expenses under the rent expense category. We do have a separate repair and maintenance expense category. This is meant exclusively for repairs and maintenance that are done specifically to the office area of the home. And therefore, we would be able to take 100% of them, as opposed to a repair and maintenance that's done to the whole home, like the roof, for example, where we would only take 25% of that. So you can imagine if you were doing a specific renovation or repair to your office, like let's imagine, I don't know, the wiring went south in your office space and you had to fix the wiring in your office. We could potentially claim 100% of that, and that would fall under the repairs and maintenance section. In addition, if you actually own property through your corporation, which some people do, it might be repairs and maintenance specific to that property where you're again going to be able to claim 100% of it. Next, we have telephone expense, which actually should read telephone and internet. So this is typically cell phones, internet usage. We say claim 100% of the telephone. Even if there are some personal calls made here and there, you need to be available 24/7 to your clients, which means that cell phone is, as far as we're concerned, 100% deductible. Same rules for internet. Now, when it comes to the home telephone line, as we said earlier, the primary home telephone line is specifically disallowed. So if you have a bill that's got, long distance call waiting, secondary lines, then you have to subtract out the primary line and then you can claim the rest. If you're doing any sort of calling card programs, cell phones, internet, VoIP, all of that is going to be deductible without any issue and would fall under telephone and should really be changed to telephone and internet. Next, we have professional fees. This is typically for if you're going to have any legal fees or you're going to have any other professional fees that might relate to your corporation. Those would fall under professional fees. Accounting fees, as we said earlier, have their own category. Professional fees, these are more meant for legal fees if you're doing any business contracts or anything like that, or God forbid you've been sued, would probably typically fall under professional fees expense. Next, we have the travel expense category. And the travel expense category is, for the most part, pretty straightforward. It's travel. The one thing we want to say when it comes to travel is your travel expense category is a great tool to be able to combine personal and business. So if you want to go down to Jamaica for a family vacation, if you can try and find a conference that's going on in Jamaica, you could potentially find a way to deduct it, at the very least, some of that hotel bill and, some of the flights, certainly for yourself. I don't think we're going to be able to deduct your kids flying down there unless they're old enough to be part of the business. But you and your spouse or your partner might be able to deduct all of your meals and entertainment while the conference is going on, as well as the travel and things. Other things that you can do outside of conferences is look for investment opportunities. So if you are going to look at potential investment opportunities for your business, looking at real estate, which is a common investment inside of small businesses, it's just really important to wrap that in as much documentation as you possibly can. Because you can assume that when you're going to the Caribbean, that CRA is going to assume it's personal until you can demonstrate that there is a business reason behind this. So all of this is around how do we present this to an auditor if we ever go through that circumstance of having to go through an audit. So how do we wrap this in as much documentation to make this stand up and be able to remain as a legitimate deductible business expense? So documentation, documentation, documentation. Get business cards, get photos, get names and contact information for all the people that you're networking with and building relationships with, and put that into a file so that if you ever get audited, you have that. So wages and salaries expense. This is typically wages and salaries for people other than directors. So if you're doing income splitting with your wife or your children, typically we're going to expense that under directors' fees. If you have traditional employees, or for some clients, they like to separate their children or their spouse from their directors because they're not directors of the corporation, that will fall under wages and salaries expense. Lastly is the sort of non-deductible lifestyle expense category. And this is just sort of meant as a catch-all to give you a place to put all the expenses that aren't deductible, but give you in a way that you can track absolutely everything. It's not going to be deductible. You're not going to see it on the income statement, but we do put it out there as a category in our chart of accounts. And in fact, I believe in our latest chart of accounts, there's subcategories for the non-deductible lifestyle expenses to help you just sort of keep track and understand where your money is going. That is a really important thing of organizing your finances. It's not only about organizing your corporate finances, it's about organizing all of your finances and getting a picture for where your money is going and making a conscious decision that if you're spending, a larger amount than the average on travel, that's because it's a conscious decision. If you're spending a larger amount than average on meals and entertainment, that's a conscious decision. Doesn't mean there's anything wrong with it, but you want to be aware of where all of your money is going so that you're making informed decisions about how you're managing your money. And this will help you to organize your finances, which will in turn allow you to create wealth, which will in turn allow you to transition this into a legacy, which you will hear me repeat over and over and over again. Next, we get to assets, and I don't know why this comes in after. Got some work to do on my PowerPoint skills, apparently. And I do see some questions that have come up, so let me try and use this as an opportunity to jump over there if I can get my mouse to work. Come on, mouse. Where are you? Okay. So let me first go to the Q&A. What is the name of the insurance company for errors and omissions? LMS ProLink. And I think it's lms.ca is their website. So I hope that answers your question. Joe McKay was one of the founders, sort of retired now, but we've worked with them for, again, decades. Is there a category for deducting the cost of exercise equipment, such as a treadmill? The question is, can you deduct this as a business expense? It's going to be very probably hard to justify exercise equipment as to helping your business earn income. I know lots of people have tried to justify, well, if I'm not healthy, then I can't run my business. CRA doesn't typically buy into that category. If you want to roll the dice and be aggressive and take the risk that your justification is reasonable, it's not obviously specifically disallowed by the Income Tax Act, which effectively means that if you've got a reasonable position, we'll allow you to put it in. We just can't guarantee that you'll keep it. Exercise equipment would effectively be an asset. So you'd probably want to put that under. These days, I'd say my treadmill is going to be probably a computer supply or computer hardware, I would say, or something like that. It's going to be certainly an asset, or office equipment or office furniture. One of those asset categories would probably be the most likely place to find that. But unfortunately, I think it's going to be hard pressed to claim your exercise equipment as being business related. That being said, if you are a personal trainer, completely different story, right? But if you're not a personal trainer, it's going to be hard to justify. If I have a home office, can the cost of kitchen supplies like coffee to boil? Yeah, absolutely. So you can imagine if you have a physical office, you provided office for your staff or coffee for your staff, it's going to be deductible. So I believe that's a reasonable position, in my opinion. So yes. Does a conference or business meeting while travel need to be during the entire stay to be able to be fully deductible? So the operative word there would be fully. I would say yes. However, you can get a big chunk of your trip because you think about it, like the airfare. Even if you stay, like if you choose to stay a week longer, the airfare is going to be fully deductible because there's no real difference between a week or 2 week in the airfare costs. But the hotel for the second week is probably going to be hard to justify from a. And again, this comes down to reasonableness. And again, that expression, pigs get fat, hogs get slaughtered. So that's my guidance on that. So I would claim a portion of it, but probably not 100%. Okay. And I haven't done a good job of keeping this short. I've got a lot longer than I was planning. I was trying to keep this to half an hour, but I just don't shut up. I'll try and keep this part pretty brief. So there's basically a couple of different categories that we use for capital assets. Automobile. Now, first of all, we do not recommend that you purchase vehicles under the corporate name, but if you do, they would be a capital asset. Now, the reason we don't recommend that is because there's a whole bunch of extra work that needs to go into it and no extra benefit. If the automobile, if you are choosing to purchase it, can be purchased under the personal name, and you can still reimburse the individual for all the expenses related to that. So you don't need to purchase it under the corporate name in order for it to be deductible. So we don't normally recommend automobile, but some people do. And if you do, again, that's going to go under this class, and then we're going to have gain or loss on disposal, and we're going to have to track it in a much more formal way. Computer equipment, pretty self-explanatory. That's going to be the actual physical hardware. Again, typically we use as a guideline around $200 to $300. There are new rules that allow you to expense a lot more of the computer equipment. The government's starting to realize that computers are almost disposable. But we do ask you to track anything that's typically over about $300 under computer equipment. Computer software, again, if it's under $200, then we can expense it under computer supplies. If it is also software as a service, that is like QuickBooks Online, something like that, where you're buying it as software as a service. You're not like downloading a software and installing it. You're just paying a monthly subscription. Monthly subscription would again go under computer supplies. Office equipment. This is where you might find things like that treadmill, which is pretty aggressive, but you might have office equipment that would fall under here. You might have things like photocopiers, big actual more industrial sort of office equipment. Again, pretty rare these days. And then last but not least, office furniture, desks, chairs, those types of things. So hopefully that's pretty straightforward on what categories there are. I'm not going to talk about the depreciation rates or the depreciation methods and how that all works, because we handle all that for you. And if you're not a client of ours, it's Googleable. The rates are prescribed by CRA. You can go to the CRA website and they'll tell you all about that. So with that, I'll also give you guys some places you guys can go to get more information. Oh, yeah, sorry. I'm going to skip over this. More stuff about, capital assets. What do I have here? Okay, so first place to get more information, join our Facebook group. Please come and hang out with us. It's called the Self-Employed Support Network. We have a very small group, but growing, of all of our clients, as well as anyone in the community. We want to encourage you guys to connect with each other. It's something that's been really important to me in the accounting world. I belong to a number of networking groups on Facebook where we provide peer support. And of course, we're in there too. So we're in there answering questions. People post things. And if we can answer a question in a group setting where we can help many clients at once, we will do that for free, as opposed to if you want to ask that in a private setting and you want to talk to me privately, I'm $350 an hour. Happy to do it, but I'm not free. If you post it in the Facebook group, you can get that question answered for free as long as you're willing for the answer to be posted publicly. We also have other training sessions like this that you can find on our website under cpa4it.ca/events. We also have a free resources section where you're going to find our chart of accounts, our cred manual, all this fun stuff. And that's cpa4it.sharefile.com. And last but not least, for those of you who want to get those rates from depreciation, there's the government website, cra-arc-gc.ca, which is full of a ton of information. And with that, I think we are wrapped. I do see some questions coming in, so I'm going to open up for Q&A now. I want to thank you for your time, and I'm sorry I went to the full hour. First time doing this session. I know I've still got more to cut, but thank you for staying with me. Can you copy and paste the various URLs in the chat box? Yes, I can do that. Second, will you be sharing the recording from today's session? I signed in about 20 minutes late. So this is streaming live on Facebook, which means you can go back to our Facebook channel anytime you want, and that will be there. In addition, typically in about a week's time, this will be uploaded to our YouTube channel as well. So yes, the recording will be available. And let me see if I can go back and copy and paste these URLs for you into the chat. Oh, okay. I'm going to have to go here. I hate that my almost there. I'm coming. There's one. There's two. Now this next one, share file, does require you to be a client and does require you to have a user ID and password. If you don't know what your password is, just enter in your email address, just do a password reset, and they will send you your password. So let me see what else has been going on in the chat. It's $500. Oh, $500. Rachel's telling me $500 is the threshold, not 300. So we can raise that bar for assets and depreciation, I guess. We're recognizing inflation, folks. During COVID, I was not able to network under typical methods. I opted to set up my porch to be able to temporarily heat it for meetings, dinners, etc. Can I write off the materials to do that? I would certainly say you have a defensible position. And I'm always I'm an advocate. If you have anything like a defensible position where we think we have an argument that we can win, go for it, claim it. The worst case scenario is CRA tells you can't deduct it and you're back to what you would have been without it anyways. So I'm always of the mindset that let's let CRA tell us we can't deduct it. Obviously, it's a very unique circumstance. I don't think anyone envisioned that when they were writing the Income Tax Act, that we would be going through a global pandemic and you would have to completely rearrange the way you network and meet with people, and that you couldn't meet with people indoors. Can I please restate in the first year slide? I'm not sure. I'll go back and run through the slides. I'm not sure which slide. What about digital nomads who travel while working? How does the expense rules apply then? There's no difference. It's the one thing that you're going to be under a situation is, you can't call that meals while travel if you're a digital nomad. If you don't have a central base, it's hard to say that you're traveling for business and then it's meals while travel. But everything else will be exactly the same. So let me go back and see which slide you were referring to when it comes to first year slide. So agenda, how we add value, a process. Is this maybe what meant by first year? Oh, by the way, the one I skipped over, stop wasting time on receipts. For all of you using traditional bookkeeping and entering this into an Excel spreadsheet, if you're a client of ours, you get Receipt Bank free of charge, people. This is a software that charges like 20 bucks a month for the tool. And we pay for a global license so that we can give it to you guys for free. It is a game changer. It is OCR technology in the palm of your hand. You just have to take a picture. Go download it, cpa4it.ca/receiptbank. Take advantage. You can then create a CSV. If you don't want to use QBO and pay for a QBO license, you don't have to do that. You can still use this, export it to a CSV and put it into our cred manual or run your own pivot tables or do whatever you want. This is an amazing tool. Use it. Yeah, and so I'm not sure what you meant by first year slide, but hopefully that answers your question. Can you expense digital newspapers, magazines, etc.? Yes. Quite common these days. Okay. I think I have answered everyone's question. We're wrapping at the original wrap time, which is, I guess, good, but we went about half an hour long. For those of you, I plan to try and do it for 20 minutes. I will tighten this up and I will get it down to half an hour. But thank you everyone for joining us today. After capital asset slide, there was in the first year slide. This is capital assets. Oh, I see. Yeah. In first year, prepare a list of business assets you wish to transfer to your business, i.e. library, computers. Yes. So if this is your first year and you do have assets that you want to transfer into your business, you can do that. That's probably a good thing to point out that I somewhat skipped over. But you can't transfer them in at the purchase price. You have to transfer them in at their fair market value and not the replacement value. This is definitely a little bit subjective, open to interpretation, open to being called out by CRA. But yes, if you have any significant assets, like, if you have a $5,000 MacBook Pro and you want to transfer it in, you can do that. Okay, excellent. So we'll call it a wrap there. Thank you, everyone. And we'll see you at our next session and connect soon. Bye for now, everybody. Come on, mouse. I can't even end this. There we are.